Hey guys, Philipp Schaedler here, a local real estate agent in Los Angeles, and today I have a special friend of mine from Loan Depot, Michael Ruhland, and we're going to talk about where the mortgage rates are heading and is there a housing crash coming. Stay tuned for more information. Great. Thank you, Michael. Thank you so much for coming in today and for this short interview. I just want to kind of get a feel of what the mortgage market is like, and maybe you can just quickly say to the audience who you are and what you do really quick, and then we'll dive right into it. I won't take up too much of your time. I know you're a busy guy.
No, well, I really appreciate you having me. Thank you very much. So my name is Michael Ruhland, and I am with Loan Depot. I'm a sales manager in Santa Clarita. Of course, we are a nationwide company, so we do loans in all 50 states. I've been in the mortgage industry since 2005, so 17 years. I've been in mortgages. Before that, I was actually a financial advisor. I was a stockbroker. So in all, I've been in financial services for over 20 years. But mortgage is really where I found my passion and my my ability to really help people. I felt I made the biggest impact through helping people with their home financing, whether that's purchasing a home or refinancing a home. So that's a little bit about me. Loan Depot is the second largest non-bank lender in the country. We're actually doing more volume than even Wells Fargo at this point. We're proud to say we're the official lender of Major League Baseball, and being a sports guy, I think that's kind of cool. And we're proud to say that we're doing really good things. We're very innovative. We're a very tech-heavy company, but also we have loan officers, boots on the ground to assist people locally to help them again purchase or refinance a home. And so, anyways, that's a little bit about me. I appreciate you asking.
Yeah, it was funny, but last time we had the meeting, we're both members of the advisory group. And I think it was about 4 weeks ago, you had done this magic jumbo loan for 3.35%, I remember, with 0 points. And that was only about, 4 weeks ago? How did you pull that off? Because I didn't think those rates were still available.
Yeah, that's a great question. So, first and foremost, just step back a little bit. I mean, rates are very much in flux. So we're seeing big swings in the bond market. And so one day they can be one thing, the next day they can be another. So, but I think there's a couple things that are really important here. Going back a year, even 7-8 months, the bread and butter we were all doing is a 30-year fixed mortgage. And why wouldn't we? I bought a new house in September. I took a 30-year fixed, 2.875%. Great rate, right?
Yep.
Easy, vanilla, cookie cutter. Well, as you mentioned, Philip, and you're a real estate professional, things have changed greatly. And so, and we can talk about that as much or as little as you like. But so what's happened is especially these last few months, but particularly really in 2022, is we've had to get creative with our financing again. So we have looked to things like adjustable rate mortgage again. And a very different program and very different qualifications from what got us in trouble in 2008.
I was just going to mention that. Yep. Okay.
Yeah. We're not talking about stated income where you can just have a heartbeat and get a loan. We're not talking about that. You have to fully credit qualify. We're not talking about a loan that has a negative amortization to where you're making a small payment, but you're literally going backwards every month. We're not talking about that. But we are talking about people looking at more creative financing to try to take advantage of what the current market has to bear. And so at the time when I did that jumbo loan, that was a 5-year adjustable rate mortgage. And the client took advantage of a dip in the market. And today they're certainly a bit higher than that, but still far more competitive than your cookie cutter 30-year fixed.
Okay.
And so we're looking at these programs again, and I want to be very clear. It doesn't mean they're for everybody. The 30-year fixed vanilla is a great loan, and I do a lot of them. I would say I still do. The majority is a 30-year fixed mortgage.
Right.
But there are other options out there to help people, and I think the key is this: and I know you do this as a realtor, right? We lay out different options for our clients, and then it is on us to do a really good job, a thorough job explaining what these programs are, the ramifications, the highs, the lows, the good, the bad, right? And we present these options to our clients, and we let them make a choice that's best for them and their family. And that's what we're doing here. And the nice thing is we have a lot of options.
It's interesting. Personally, me, I always would go for a 30-year fixed loan because I live in my place. I'm going to be living in it for a while. So for me, that's peace of mind. But I understand probably for an investor's point of view, or if you want to flip a house for a year or two, then probably the adjustable mortgage might be an idea, right? Might be a more appropriate vehicle. One of the things that I've noticed, and a lot of buyers have become disenchanted because the rates have gone up so much. I think we had the first half-point raise in 22 years. Usually it's a 0.25%, right? So they were really aggressively pushing it up quickly. So they're kind of disappearing, but I'm trying to tell them that even at 5 and 6%, because I think when I had bought my places was 2018, late 2017, it was around 6-5%, right? So we're kind of back to normal. I don't think the 5 and 6% is that tremendously high. What do you say to that?
Yeah, I mean, if you look historically, a 5, even a low 6% mortgage rate is extremely low comparative to how interest rates have been over the last 75 years.
Right.
So what happens though is we are all subjected to advertising, right? And when rates were at their lowest, you were bombarded on radio, the internet, and TV, and seeing these rates flash across your screen. And it gets stuck in our head. And I understand everybody wants to save money. Everybody wants to get the lowest interest rate. Of course, again, I have a family. I just bought a home. I get the whole thing. You have to look at the big picture. You have to look at the entire spectrum of what we're talking about when we talk about high interest rates. I mean, in the 80s, people were paying, 16, 17, 18%, right? In 2005, if I gave you a 6.5% rate, you were giving me a big hug. So I think that if you're looking at the overall picture, rates are still very, very competitive. And again, there's these other products that can help you get more competitive. Yeah, but I'd like to touch base on this very point, if I could quickly, Philip.
Sure.
And that is that I tell my clients, look, you should be situationally buying. And what I mean by that is this. I'm gonna share my personal story on me buying this house. I lived in a townhome with my wife and my 2 daughters. We were there for 17 years, obviously prior to my kids coming along. My daughters are 12 and 9. But my 2 daughters were we were living in this 2-bedroom townhome, and my daughters shared a room. And unfortunately, the street outside of our townhome got busier and busier and busier. Kids were sharing a room. It was loud. There was a bit of a homeless problem across the street. Our life situation said, hey, we need to move along. For those reasons, we moved, not because of where home prices were, not because of where interest rates were, but because my life situation, I was ready to buy a new home. And so what I stress to my clients is listen, if you're trying to time the market, if you're looking at interest rates and home prices and not focusing on your true why do you want to buy a home? I think you're taking your eye off the ball a little bit, and you're subjecting yourself to some pain because now you're focusing on the wrong things. So I tell my clients, I actually have a list, and I say, write down why you want to move. Nobody ever writes down because interest rates are low. Nobody ever writes down because I think the housing market is low. What people write down is, I have these 2 big dogs and I want them to have a yard. My children, we want them to go to this certain school district, right? And we need more room, or we're downsizing. Our family, our kids, we're empty nesters, and it's time for us to downsize. So all these things are really the real reasons why.
I lost it there for a moment. Okay. To your point, in the 1983, 84, I was actually working real estate in Vail, Colorado, and it was exactly 16% interest rate, to your first point. And to your second point, which I think is a very good point, when buyers, this is what I told buyers, you can argue on both sides. Is it a good time to buy, right? Is it too high? Is it too low, the interest rate? And what my answer always is, look, I have known people who've had the money to buy a property, but they waited, right? Because maybe the interest rate was too high, and then they spent this money otherwise, and it's no longer available. They missed their chance, basically. This happened quite often. I hear this story. And so my answer always is, if you're buying for the long term, you really cannot go wrong. I mean, if you're buying for 5 years, maybe it's a risk, but 10, 20 years. I know a guy who bought in 2008, just before the crash. And yes, it took him 10 years to recover, but he did recover. But the point is, you know, if you're buying something to actually stay in a while, I think it's a good time to buy pretty much any time. And so the question I had for you, there are some programs I heard, and you guys actually came up with that from the state. And one is where the state gives you a 10% down payment. I guess this is only for certain qualified first-time home buyers. And also the state is a program where they give you a loan, a zero interest loan for a down payment. And you guys were actually mentioned as one of the lenders that handles it. Do you know anything about these programs?
Yeah, so the two big programs, and I'll kind of paint with a broad stroke here, right, and happy to answer more specific questions if clients have them. But the two biggest programs in the state of California are run by the Golden State Finance Authority and the California Housing Finance Authority. So CalHFA and GSFA. Right. And your clients can go and look those programs up. Okay. So here's what I tell everybody. The first and the most important aspect of these programs is I tell folks, if you have your own down payment, I strongly suggest you use it for a couple reasons. Mm-hmm. One, and I don't mean to jump into, like, I don't know if you call it negative, but I want to be very real with with your viewers here. So if you have your own down payment, you know, why wouldn't I get this free money from the state? So I tell everybody, first and foremost, look, there's no free lunch. There are programs, there are grants through the Golden State Finance Authority. There's actually a grant. You don't have to pay it back. I mean, there's some cool stuff, but everything comes at a cost. So traditionally, the rates can be higher. The fees can absolutely and oftentimes are higher. Okay. Here's the other important thing. And again, I do these programs. I know them intimately. My company does a lot of them. So not to scare anybody away from these programs, but just full disclosure here. We are still in a seller's market. Now, you're the real estate professional. I'm sure you'll tell me, I know that more houses are coming on the market. We're seeing higher inventory levels. Homes are staying on the market longer. But it's still, in my opinion, and I defer to you, as a seller's market. So if you're a seller and you get 5, 6, 7 offers, and you see one come through with a down payment assistance where the buyer doesn't have a lot of skin in the game, that could be perceived as a negative thing. Now, I know real estate professionals like yourself. I know that you have ways to overcome those objections through listing agents. I know you have a tremendous amount of relationships with your local real estate partners, and they trust and like you. And I know that's why buyers come to you. I know that's why sellers do business with you, is because of your reputation. So that's really important. But it's just, here's what I tell people. The bottom line is this, Philip. If you're going to use a down payment assistance program, just make sure you really need it. If you need it, look, there's really three things that matter most in a mortgage application. 3 very simple things. 1 is your credit and your credit history. 2 is how affordable is the monthly payment. And number 3 is the down payment. If you're good on your credit score, if the debt to income ratio works, but the only thing that you're really struggling to do is come up with a down payment, I strongly urge any of your clients to look at the down payment assistance options, because they're great and they're valid. So I don't want to discourage anybody in the slightest bit. All I'm trying to say, though, is if out of those 3 things, down payment isn't your hot button, isn't something that you need help with, I just wouldn't take it. Does that make sense?
Okay, that makes sense. Yeah, but on top of that, I have a question. So let's just say you have the down payment. Okay. You would qualify for this program. You would use it. Now you would have 2 down payments, which could lower your monthly payments. Is that possible? Can you do that? Could you apply for that program?
It is possible.
Put on your own?
You could. But remember too that there is a cost associated with the program. So now some of your money is going the other way, in the sense of the fees that are present in all of them. The interest rates can and oftentimes are higher. So now you're paying for that over time. And number 3 is what I kind of referred to again with seller perception. So I tell my clients, generally speaking, hey, if you've got the down payment, I would use it. If you need it, that's what it's there for. They're great programs. We do a lot of them. And ultimately, it comes up to the client, the relationship, the client with the realtor, and the overall market they're looking to buy in.
Right. Yeah, no, that makes sense. Absolutely. On the average right now, do you see, I mean, I've read like 12% is the average down payment. Is that correct these days, or is it more? I've seen 12%.
I think the average is probably around 10. Yeah, 10,
Okay.
12%. I think that's average. Look, I mean, there's programs that'll allow you to put down without down payment assistance as little as 3%.
Right.
And that's not FHA, by the way. There are programs that allow you to put as little as 3% down. And of course, some of your benchmarks are 3, 5, 10, 15, and then of course 20. 20 being the magic number, if you will, because it helps avoid PMI or mortgage insurance.
Correct.
But yeah, that's a great question. And I would agree with you. You're probably around 10, 12% is the average down payment. I think what's important to express to our clients, though, is that don't let any one thing discourage you from doing an application and finding out where you're at today, because you and I can work together to help them achieve their goals. So look, I mean, and I know you know this too, right? So I meet clients and they're either ready to buy right now, which is great. They walk into my office, we're ready to go. And then I meet clients that maybe we have some work to do. And that's okay, because we're in it for the long haul. So whether we need to work on cleaning up some debt, increasing the credit score, saving some money, whatever it may be, you don't know how to get where you're going unless you know where you're at today. And so what I always encourage clients, to do a loan application with us, there's no fees to do it. There's no obligation. They're not marrying themselves to me or Loan Depot. But it's like having a really good physical, and telling you, here's where you're at today. Here's where your health is today. And here's where your home buying health is today. Really very similar.
This is an interesting point you're just touching. And the reason why I brought it up about the average down payment percentage, because a lot of buyers believe you have to have 20%. Now, I understand the 20% and higher, you don't pay the PMI, the private mortgage, the property insurance, the mortgage insurance. But what I noticed is a lot of buyers, especially first-time home buyers, are afraid to take that step to talk to a lender, right? They tell me, okay, I'm going to call them, and then I check with them, and then they haven't. And so what I'm trying to take for the audience, for the first-time home buyer, try to take that fear away, and you just touched on that. So we want to make it very clear, if they contact you, there is no obligation, there's no cost, correct, to find out if they would qualify. Is that correct?
100%. And I'll tell you, I can't speak for other loan officers, but I do things quite differently. And here's what I mean. When I meet a client, whether we're talking over the phone or in person, I tell them, hey, you don't need to bring a bunch of documents. You don't need to send me a bunch of things. What I want to do is just have a cup of coffee with you, whether in person or even over the phone. We're going to have a casual conversation. I want to get to know you. I want to get to know you as a person. Most importantly, get to know your family as the people they are. Find out what your hot buttons are, what your fears are, what your concerns are, and get to know you so I can best help you. And then that benchmark is the loan application. I'll tell you a funny story. I shared, and I'm always sharing my own personal stuff. And so I told you that my wife and I just recently bought a home, and my wife is an accounting manager for Disney, and she's been there almost 20 years. And of course, I told you I've been doing finance for a long time. And when we decided to buy the house, we wanted to buy a new house, she said, well, how much house can we afford?
Right.
And I looked at her like I was the deer in headlights. And I said, I had no idea. And she shook her head. She goes, isn't that what you do for a living? How would you possibly not know how much home we can afford? How is that physically possible? And I swear my answer to her is the same answer I give my clients. I go, I haven't done our application. I don't know exactly where our credit scores are. And even if you use Credit Karma, they're different algorithms than the mortgage credit scores. And I honestly, I really didn't know exactly what she made last year. I had an idea what I made. And then I don't know exactly what debts we had.
Right. No, that makes sense. Sense. You need,
we all kind of put our pants on the same way. We had to take, so I sat down with a Loan Depot loan officer, because I can't do my own loan. And they asked me some questions, got to know me a little bit. It's not as intimidating as it seems. We had a casual conversation, and from there, we eventually bought a home. But I think you're absolutely right about the intimidation factor, and I try to break that down. It's a casual conversation.
Yeah, and it happens so many times. I don't know why they won't call, and I keep telling them, it's free, it's no obligation, no cost, but it gives you an idea. You need to put in data to get out the data to find out what you can afford, what your purchasing power is. That's a big one.
Yeah, and I think, and if I could even add on to it, because I just think your point is so important. People don't want to be. I believe in everybody's heart, they don't want to be sold. Anything.
Yes, exactly.
They don't want to be sold anything.
Yep.
They don't want to have to go further. Once they want to take the steps they want to take when they want to take them based on their comfort level. And who wouldn't? I'm the exact same way. I'll buy what I want to buy. I'm 49 years old, but you're not going to sell me anything. I don't like that any more than anybody else.
Right. And I think that is a key.
So I think when people call, the mortgage application is a progression of a conversation. Right. But it's not, I don't start with an application. I start with a cup of coffee. And if you, the client, choose and want to take that step, that's great. But that's really up to the client. And I enjoy having these casual conversations and see where they lead.
That's great. No, I mean, that's really great to know, because I can tell clients, that the first thing to do is just have a cup of coffee with you and just see where it goes from there. No obligation, no cost, no nothing, no pressure. And I think to your point, you're right, nobody wants to be sold anything. They may be, I think that one of their thoughts is, if I call this lender now, I'm going to be hounded every day. I'm going to get phone calls and texts and be bombarded. And that's really not the case, because either it works out and you move forward, or it doesn't, right? I mean, that's how I see it, when it comes to
absolutely. I mean, absolutely. Yeah, absolutely. Look, I want to do business with people when and if they're ready and they want to do business with me. Right. It really is that simple. It's a mutual, it's a relationship, as you know, right? We spend a lot of time with our clients, and
all about.
I know I've had clients I've worked with for years before they got. Sorry, I don't know what happened here.
I know it kind of goes in and out.
Let's see.
Got it.
Oh, there we are. Sorry about that. I have my do not disturb on, but I'm not a Zoom expert.
Okay, no problem.
But no, I think it's very important to break down those barriers and to make people feel comfortable. Absolutely, and then they ultimately they're the captain of the ship.
Yes, exactly. Yeah. I have a
100%.
couple more questions for you. One, and this is the big subject right now. Do you see a crash coming? I don't see one coming, but I want to get your point. As a matter of fact, I think that raising of the
broke up a little bit, Philip.
Oh, sorry. Yeah, let me just repeat it. Can you hear me?
Yeah, I hear you great now.
Okay.
Yeah, sorry.
So the question was, if you think there's a crash coming, and I would say no. And the reason, for me, my opinion is the raising of the interest rate is what stabilizes the market, actually. But I want to hear your input on that.
Yeah, I have a few things I'm happy to share. And look, I don't claim to have a crystal ball, that's for sure. Right. But we essentially are so short on inventory that if home builders increase their production by 25%, it would take 19 years to play catch up to where the demand equaled the supply. 19 years. We are way, way behind on supply. And they do that intentionally. And they do it because they don't want to be stuck with inventory. So home builders are notoriously behind, again, purposely, so they make sure they sell every house as fast as possible. That's how they turn these profits. It's about speed. Right. So we are way behind on inventory. That's number one. Number two is we have responsible lending. You have to show your paycheck stubs, your tax returns, your W-2s, all these things. So we have a very responsible lending system in place, which we did not have in 2008. We have responsible appraisals. So now they're truly a third-party evaluation of the property with no manipulation. And I could go on, but there's a lot of regulation that was put in place post Great Recession that has afforded us protections. And I say us because I'm a consumer too. And, I have two children, as I mentioned. So we're all in this together. And, this is my career. I don't want to see it torn apart. Right. So we're all in this together. So look, there's a lot of things in place. Now, the other thing was I would like to talk about is interest rates, because I have my own kind of theory on interest rates and the Federal Reserve. So look, the Federal Reserve, when they raise interest rates, what they are raising is the overnight lending rate that banks pay to borrow money. That is the Fed funds rate. While it can certainly affect mortgage interest rates and all sorts of debt instruments, it is not a direct correlation between when the Fed raises rates. Now, programs like a home equity line of credit that is tied to an index that is tied to the Fed funds rate is very sensitive to the Fed raising interest rates. But here's an interesting thing that happened. The Fed raised interest rates, and what you see sometimes is that mortgage interest rates actually go down. And I'll explain the theory. So in July, I think you're going to see another 0.5% rise in interest rates from the Fed. And that's another, as you mentioned, aggressive move.
Yeah.
The thing of it is that we are having runaway inflation. This is the hottest inflation we've seen in 45 years. The Fed can do two things. They can raise interest rates. They can lower interest rates. That's their main tools. So to slow down this runaway inflation, go price up a flight to Seattle, or New York. It's crazy. I don't need to tell people what it costs to fill up their gas tanks, right? Or buy food. So we all know. Okay, I won't go there. But here's the theory. They start raising interest rates. Well, what that does is that makes expansion more expensive, especially for businesses. The perception is that it's going to slow down the economy, which of course it most likely will. And the Fed chairman went from saying we're looking for a smooth landing to I'm not so sure what we're in for, but we have to hedge inflation. So they raise interest rates. What happens is that it spooks the stock market. People feel that corporate earnings are going to shrink because they're not going to be able to expand, and there'll be a lot less growth. Now they're talking about a bear market in the stock market. Well, where do people put money when the stock market starts to turn? They put it in the bond market for security. Gold. But they put it in more secure instruments, right? But they also put it in the bond market. So in the past week, we've seen interest rates actually go down. And I think as the Fed aggressively raises interest rates, you could actually see an inverse relationship between the Fed funds rate and the 10-year bond, because I think it's going to be looked upon as an avenue of escape, of security for folks that are running from a potential crash in the stock market. And so what you could see is interest rates go lower. With this increased inventory, homes are coming out. I think you're going to see a fairly robust real estate market, and I don't see some big crash. And here's another thing to be very mindful of. And I could talk about this for days, so I'm sorry to take so much time.
That's okay.
Rents from February of 21 to February of 22, rent was up 13%. It's a big hike. Rents are not cheap. Listen, any of your viewers go out there and start pricing up rentals. That's no safe haven. So I think what you can look for is more homes on the market. I think rates are stabilizing and could go down. And again, since none of us have a crystal ball, I go back to the why you're buying. Work with a real estate professional like Philip. You really are an amazing guy. You do a phenomenal job with your clients. And hang in there. Focus on the why. Put the why on your refrigerator. Right. Why are you really buying a house? Are you doing it for the right reasons? And then stay in the game. And again, as you mentioned, buying for the long term. And if you're not buying for the long term, that's okay, right? Let's take a guy or gal, and her job is said, hey, you're going to move to Texas in 2027. You're gone, right? So so look at these other instruments, maybe like a 5-7 year adjustable rate. Plan for what you think is going to be and utilize the tools out there to do the best you can for your family. I think the tools are there. I don't think a crash is coming. And I think that, it's a matter of getting the right advice and
that's
working with people who are willing to listen and take the time to hear what you need.
We got a couple more minutes left. And no, I totally agree with you. There is one fine line, because I noticed that builders only build 11% of their planned projects. I just read a report about that. And part of it is a supply chain issue. And of course, also the concrete and lumber has gone up. So now that calculation doesn't add up anymore with several projects. So there may be Some they're being abandoned. They're talking about, just abandoning half the project, half finished. But what I did notice is because people thought that the market is coming to a height, more sellers have come forward. I don't know if you noticed that, but I noticed that more sellers have come into the market thinking, I'm going to cash out real quick before it goes down. But I think so too, as long as we have this drastic low inventory, I just don't think we're going to see. I just showed a property a week ago. There were 4 couples on the sidewalk getting into the open house. It was packed. It was just so many people. And so the demand is there. So I don't see a crash coming. But one more question. I have a question before we go. I always ask my interviewers, do you have any crazy loan stories that you ever had gone through? Anything strange or bizarre or funny to talk about, if you can think of something? If not, it's not a big deal.
No, that's a great question. Oh, yeah, I do. I tell you, yeah, this happened recently. That's okay. Oh my gosh! I almost. Okay, I got a great one. And for his client, he calls me. He said, "Mike, we've got a problem." And I go, "Well, what's the problem?" I go, and my realtor, he's a great guy. He goes, "Well, it's the HOA." And I go, "Well, what's wrong?" He goes, "They won't allow. My client has a pig." And I go, "What?" The client has 150-pound pot-bellied pig, and they didn't tell anybody about the pig. Right. They didn't tell anybody about the pig. We get in contract, and they said, "Oh, by the way, Sir Bacon, what was his name? Sir Francis Bacon. That was the pig's name, Sir Francis Bacon. We have this pig. What do we do?" They went to the HOA. The HOA said, "Well, we've never dealt with anything like this. We don't know what to do with a pig. We're used to dealing with, you had a big dog or you got whatever." So eventually they had to walk away from that house and find an HOA or find a property without an HOA so they could have Sir Francis Bacon, because this is the love of their life. And by the way, on a side note, I've been told that pigs are smarter than dogs. Did you know that?
Yep.
I didn't know that.
I've heard that too.
But we eventually got them a house. They closed escrow, and Sir Francis Bacon is Sir Francis Bacon is happy and healthy.
That's great. That is a fantastic story.
True story.
Hey, Michael.
True story. Recent true story.
Recent, even that's even better. Where do people get a hold of you? I'm going to put that later in there. But what's the phone number when people want to get a hold of you for lending purposes?
Sure. Yeah. So here's my cell phone. I only have one phone. It's always on. I love what I do. So I tell people, listen, days, nights, weekends, I'm available. Like I said, I really love what I do. So my cell phone number, I'll say it twice. It's 661-310-6560. Mm-hmm. And again, I promise I'd say it twice. It's 661-310-6560. If you Google Michael Ruhland, it's RUHLAND with Loan Depot, you'll find my website, find all sorts of information about myself, my team, and we're happy to help. And I really appreciate you having me on here today, Philip. It's been a joy.
Same here.
I know your clients are in really great hands with you. Yeah. So
thank you.
Whatever I can do to be of service.
I will. And also I will put this thing on YouTube, and your info will be in the description section. So in the comment section will be all your info to contact you. Michael, thank you so much for your time. I really appreciate it. You're awesome.
Thank you.
You know a lot of stuff.
You're great.
You're the man. And we'll talk soon. It's a meeting next time, okay?
We're working on it. Yeah, I appreciate it. We're all a work in progress, me included, let me tell you. So I appreciate the kind words. Thank you for having me on. I certainly look forward to seeing you soon.
Yeah, I'll see you at the meeting next time. Okay, thank you. Bye-bye.
You got it. Take care now. Be well.
Thanks.
All right,
Bye-bye.
cheers. Bye.